Good morning. Another beautiful day in real estate. My God, dude, we've got a lot of stuff coming in today. We're going to talk oil prices. We're going to talk about what's going on in the Middle East. We're going to talk about how that's affecting the economy. And then we're going to kind of go on some tangents on what to expect in 2026 as we continue to move forward. So let's keep the energy up. First things first, let's talk about mortgage rates. Mortgage rates, they're down from our recent video by just slightly, just ticking down slightly, right? And you want to know why? In the last video, we talked about it. Oil prices are down, okay? We're going to dive into that in just a second. But 6 is the new normal, as I've talked about. But lenders right now are having incentivization out there that is absolutely nuts. Here in North Dakota, ND Housing, which is a remarkable program. And if you want me to talk more about that, if you live in North Dakota or you're planning to move here, looking for incentives to move to North Dakota, drop a comment. Let's figure out. We'll get together. We'll talk about it. Anyways, what happened was some banks, I think 4 banks here in North Dakota, partnered with ND Housing, and I believe it was a $40 million investment to permanently buy down interest rates. And there were some certain criteria. You had to be above a 700 credit score on average in the home, and you had to make under $102,000 median income, I want to say, and you can get a 4.84% interest rate. That's nuts. Because right now I'm seeing 5.7, 5.8, 5.9. I think 5.75 was the lowest I saw on a standard loan. But people are starting to move. I have 7 different showings in less than a day on my properties out of nowhere. 7 showings, 3 people ready to build, a listing going live, negotiate an offer off market for sale by owner. We'll talk about that too in just a minute. But people are ready to move. Even in North Dakota, it's snowing here today. Again, I don't know. It was 60 degrees 2 days ago. Now we've got a blizzard going on. Love North Dakota. But worst case scenario, you get to see snow in March and you get a nice house for an affordable price. Anyways, so we're at 6.09% on the average. Again, you're still seeing them trickle down, which is really, really nice. I mean, if you're talking about fixed year mortgage, 15 years, we're going to talk about 50-year mortgages again today because affordability continues to be the conversation. But before we're going to try to stay in line, let's talk about oil prices. So this is the chart of oil. Since it bottomed, or I guess you saw most recent bottom on the 26th of March or of February, right? So basically 15 days ago, 14 days ago. No, 12 days ago. Forget about the 28 days. To where it peaked on March 8th, we saw an 87% increase. Dude, that's nuts for oil. This looks like a fucking crypto token. It looks like someone put a meme going out and this is what happened, right? And it's also looking the same because of how fast it fell off. Don't let that fool you, though. I don't think that we're at the end of this oil run. We can look all the way back here. Look at that move. Dude, are you seeing any moves all the way back? Nope. The biggest one we saw was, Jesus, we saw the biggest takeoff here, and that was back in March of 22. But remember, we talked about this in the last video. In March of 22, we saw the peaks in oil pricing, and then right about here where it dropped, right about October. So right here in October, we actually saw the lowest interest rates in 2022. Something to pay attention to. Why do you think why do you think mortgage rates are ticking down today? Oil prices are down. They went down 30% upon open on Monday. 30%. So people that are freaking out about the real estate market or just about the economy in general, let's hold off for just a second, okay? Let's pay attention to what's happening. All right, I'm looking at my screen over here on my right side. So if you're wondering why I'm looking over here, we saw an 87% increase in oil. Dude, we went from 70 bucks a barrel, 65 bucks a barrel to 119, 120, 120 bucks a barrel. Dude, that's insane for the amount of period of time that we were in. Granted, things move a lot quicker in this economy and in this market than they did 4, 5, 6 years ago. But this right here shows me one thing. It shows that we are seeing a lot more uncertainty, especially in oil. Not to touch on the conflict again over in Iran, but what do most wars conflicts start with? They start with natural resources, right? That's why we saw silver, gold tear off before this happened, and now gold and silver are starting to trickle down. Wars are always fought over oil. It is what it is, but oil, right? Because the Strait of Hormuz was closed down. Now it's opened up. It's so uncertain. So everybody came up here and said, boom. And then there was a tweet that came out with President Trump saying we have maybe 3 weeks before this all blows over. And Monday morning, everything fucking tanked. I mean, it's crazy, dude. One dude has the power to move the markets that much. Anyways, I'm sure that's not the only factor, but it's crazy how that worked out. All right, bond pricing, you guys. So bond pricing started to trickle up. Remember, if oil prices are up, interest rates are coming down, and vice versa. Okay, so we're probably going to see these interest rates for the 10-year bond. They're probably going to stay right around that 4.1. They've kind of stayed there. I mean, we found the lows of about 3.97 and the highs about 4.28. So I mean, it's relatively stagnant, and it has been since, well, geez, man, all the way back to August of last year, right? So things are staying pretty stagnant as far as bond goes, which is good because that means that interest rates aren't going to fluctuate a lot. So people, again, are getting used to that 6% interest rate. They're getting used to those buy downs. They're getting used to the market that we're in. And again, I think that's partially why everybody's starting to jump off the sidelines again, man. Like, just like I said, in the last day, I had 7 showings. I had all this extra work going on, and now I am behind on work once again, which is a good thing. So anyways, the other thing popped off today was U.S. inflation remains at 2.4%. So Jerome Powell said they weren't going to be dropping interest rates until that 2.0 interest rate market, right? So we're on inflation, 2.4% inflation. He's out in 60 days. But really, I think it's May 15th or whatever they get inaugurated. But 2.4%. The one thing I will say that's very concerning about this is they have been revising numbers like nobody's business. This morning I saw they revised to February. Was it the February market? And they lost 55,000 jobs. They didn't gain, they lost. That's a lot of jobs to be lost in 1 month. So that does make the market weaker. If you're paying attention, you're hearing a lot of people talk about unemployment could reach double digits in the next year. I mean, it is possible. AI really can take over a majority of jobs. We saw Block drop 4,000 employees in a day. We've seen Amazon lay off a ton of people, UPS laying off a ton of people. You know, I think it has something to do with the AI bubble that's happening. Don't fool yourself. AI might be ripping now, but it's not going to last forever. Nothing does. It might go up 30, 40, 60%, but it will always find a correction. That's just how markets work. I don't care. It's not different this time. It never was different, okay? But anyways, inflation, you guys, that's something we should be paying attention to pretty aggressively, because as we move into this year, especially with oil prices and stuff, higher oil prices lead to higher inflation, which means interest rates have to be lowered to what? Create liquidity, right? We're going to talk about that too. So now that we're in the liquidity side of the conversation, liquidity is the big piece that is talked about at the banking system, at the federal level. You turn on any news article, on any news station, it doesn't matter, CNN, CNBC, Fox News, it doesn't matter. They're talking about liquidity, right? Granted, it's the business portion, but they're talking about liquidity. Why is that super important? Because in order to drop interest rates, you need to have money in the system. We pulled all the money out of the system over the last few years with quantitative tightening, right? So the Fed stopped buying bonds. They stopped artificially holding up the market, right? But now they're starting to push money back into the market. I think $40 billion was bought just this last week in bonds. They're now printing money again. It's a lot slower. People are referencing COVID versus now, but you got to remember COVID was an anomaly. So we fast track back, right? And I'll touch on this too. So in 2008, Obama gave $600 checks to the American people. It wasn't like COVID, but they $600 checks, right? What happened? Right after 2008, we saw 2008 was rough. Don't get me wrong. But look at what followed. The real estate market tore. Since 2009, to end of 2009, I think it was, till 2017, the market tore. We had a slight correction, and then the market ripped again, right? But COVID happened. Everything imploded. Everything changed. Then we gave the $1,200 checks. We gave the stimulus checks, and the market went on a tear again. Why? Liquidity's in the market, so interest rates can go down. That's how that works, right? So they're talking about tariff checks. It's another way to inject money into the economy, because when people get checks, 99% of you are not saving that money, not investing that money. You are taking that money. It's free money in your eyes, free money, right? And you're going to go put it into a vacation. You're going to go buy a new car, clothes, phone, whatever, right? Same thing with your tax season. I have a buddy tells me every year, It's $10,000-$15,000 back for having kids and being on certain tax brackets, etc. I'm going to save this. I'm going to invest it. A week later, that money's gone every goddamn year because people don't use their money like they should. That's, it's irrelevant in this conversation. My point is liquidity is coming to the market, and liquidity is the issue right now. That's why the economy is so stagnant. That's why you have job losses. No companies don't have money to pay people, right? Or if they do, they're moving towards AI. And we're going to be seeing that liquidity start to come back into the market. The Fed is now purchasing bonds and injecting money, and then you had the $200 billion that was injected into Fannie Mae, Freddie Mac, which brought down interest rates, right? Not only that, but you have the conversation of affordability. So don't kid yourself. These presidencies are all the same dog and pony show, all of them, every single one of them. The only difference is the policies shift, because they shift with trends, right? Right now, the shift is on affordability is up here, liquidity's up, liquidity's down here. So what are they going to do? They're going to bring I can't do anything with my hands today. They're going to bring liquidity up so interest rates can go down. What's going to happen? People are going to buy homes. They're going to buy hard assets, right? They're going to buy risk on assets. They're going to buy risk off assets. They're going to buy assets because assets create wealth. And most people are not going to be buying it. It's the few people that understand what investing means. Investing means putting money in and seeing a return over a period of time. Typically not 18 months. People got kind of into the gambling mentality during COVID, but we'll talk about that another day. My point is that we're going to see interest rates starting to come down in 2026. And we're already halfway through March. Everything's flying at this point. But we're going to see liquidity come in. Oil prices, I think, are going to continue to go up, especially with the uncertainty. You have Russia saying that the Strait of Hormuz is closed. You've got Iran saying, absolutely not. We didn't do anything. It's the United States. The United States is saying, no, it's your fault. A lot of pointing fingers. So there's a lot of uncertainty. So they're going to see oil prices go up, causing inflation, bringing interest rates down, right? Pretty simple. Now, I'm going to show you a quick portion of a video. It was an interview with Tom Lee with CNBC, and he was talking about why oil prices can be good for the economy. So let's jump in real quick like here.
Related to that, input costs on a whole number of other industries, how is that possibly good for the stock market?
Yeah, part of it's a relative. One, U.S. is an exporter of oil, so we net benefit as an economy from higher oil. The second is other countries are importers, so the U.S. not only looks better, but on a relative growth basis, it should outperform, which means flows back into the U.S. And the third is, as we worry about global growth for all the reasons you described, when growth is scarce, people buy growth stocks. The U.S. stock market is a growth index, so it's coming out of the rest of the world back into the U.S. So I think it's a rotation story.
Okay. So what he's talking about is that gold or oil can be imported, right? And this morning, another thing happened is they released the sanctions on U.S. or Russian oil. So Russian oil is going to flow again, right? We have Venezuelan oil coming in. We have the United States has a lot of oil. I live in North Dakota. I worked in the oil industry. There's a lot of oil. And dude, there are millions of barrels flowing every single day. And then you have Texas. Texas has a lot of oil, and I believe no, Alaska's got gold. Anyways, so he's talking about how bringing more money into the economy, especially if they're going to continue to utilize tariffs, importing and exporting is going to cost other countries money. I know people have their opinions on it, but let's set those aside and talk about the reality, right? So what we're going to see is we're going to see more oil flowing in and out of the United States. Okay. If we continue a war, we're going to see interest rates go down because companies are going to need to build weapons again by borrowing and creating more liquidity. So there's a lot of factors. If we open on a broad spectrum, there's a lot of factors that point to interest rates are going down and affordability is going to be taken care of, right? I shouldn't say taken care of. Things are going to break. They have to, right? Like things can't be this way. But we're still in a time. Inventory shortage is an issue. I mean, they're coming. Oh my God. Inventory is still pretty minimal. Even in here in North Dakota, I mean, we have houses selling, but it's not like it used to be, right? People are building a lot more. That's why I love being a builder. But we need to see more affordability. So 50-year mortgages, that's a topic of conversation that people hate to look at. I'm going to stand by it. It's probably going to happen. Again, interest rates come down, 50-year mortgages. dude, people are going to save and be able to buy a lot more homes again. And if they build new construction, then you can cut your home insurance in half. You can get an incentive from a builder. And if they like, we have a lender that we work with directly, he has an incentive. So like, you factor in all of these, people are going to have room to buy again. And then talk about portable mortgages. Portable mortgages where people can now take that interest rate one time, transfer it to the next home. Dude, that opens the entire 3/4 of the barrel where everybody's holding onto their home with good interest rates. Again, they're talking about, it's not set in stone, right? There's ideas on how that's going to work. But dude, if they factor that in where you can take your mortgage rate from your previous home to your next home, 2.5, 3%, 3.5%, stuff like that. Dude, people are going to do it. They're going to do it. They want new houses. I talked to 3 people recently, and just because of the equity growth in their house in the last few years, they are buying houses cash. Patio homes, retirees looking for their final homes. They say final home, but anyways. So not only that, portable mortgages, 50-year mortgages. I mean, dude, everything's painting a picture that we're going to see a nuts year. I'm already seeing it. We've had 2 60-degree days this year in North Dakota so far. 2. And one of them was a week ago, and it was beautiful. And I'm super annoyed there's snow outside, but there's only so much we can do, right? Now, the last thing we're going to touch on is kind of small. I shouldn't say small, but it's not going to shake the markets. But core CPI, so the core inflation, 0.02. The expectation was 0.02, previous 0.03, and then 2.5 for the year over year, right? Okay, it just means that the core inflation is staying pretty stagnant, and the CPI means that we're seeing a little bit of growth. Nothing crazy, right? Anyways, you guys, I don't know how much better I can paint a picture. I know I'm kind of all over the place. I'll get better at that through more videos, but this is the year to buy a home, man. I talked to somebody last week, 5.75% interest rate, and they're waiting for the market to crash. Told them, you guys, it's not coming. This isn't 2008. This isn't COVID. Policies do shift, but remember, history doesn't rhyme, or excuse me, it doesn't repeat, but it often rhymes. So it means similar things can happen, but we're not going to see the exact factor. The one thing you'll notice, and I go on X a lot because my algorithm is strictly based off of like economics and housing and crypto and stocks, and it's all economy and money because I love learning about money. Anyways, you have to understand the bigger picture. People are talking and trying to reference 2008 to 2026. There might be some similarities, but that doesn't mean we're going to see the same outcome. Because, again, history doesn't repeat, it often rhymes. But also, let's factor in this too. Something like 2008 is what they call a black swan, where it was pretty relevantly there, but people didn't see it coming, or they didn't want to see it coming, or they did see it coming and they didn't tell anybody, right? Those are the bigger companies. I'm calling you out. But this is not something where everybody's going to be posting about it and getting, feedback on it because, again, that's how social media works, right? It draws your attention. It doesn't mean it's true. So if you're going to be focusing on this, internalize it as best you can without trying to take an opinion as someone else's opinion as your own. Learn about it, internalize it, and say, okay, what makes sense to me, right? My strong suit is I can see trends, I can see cycles, and I can have a logical base behind my decision making. All right. So learning about this stuff, I can confidently talk to my clients and feel, okay, this is what we can expect. Don't get me wrong. There are a lot of factors where things are going to look negative, and I'm going to be upfront about those too as I learn about them. But right now, I still think we're not quite there yet. We're not quite yet there to the worst times. I think there's a possibility to see a boom before the midterms in November of this year. Again, dude, it's midterms. We have to look at this logically. I don't care which side of the fence you sit on. Look at what happens during them. If there's a dominant set in House, which is the Republicans right now, they're going to do everything they can to gain more seats and stay dominant so they can continue to make decisions, right? The frustrating thing about politics is you're on the left or you're on the right, and whoever has the most seats is making the rules. Whether it's a good policy or not doesn't really matter, right? So let's pay attention here. I mean, let's look at the market. Let's pay attention to what's happening. And you guys, if you want to get into a home, this is the time to be doing it because things are going to change. They're shifting. They are already shifting. Dude, this is the year to buy. This is the year to build. Let's go do it. Have a great day.